Mr. Shridhar. Now, to start with, the company has reported a slightly weak set of earnings with a loss coming in this time of close to 400 crores. So going forward, are you still optimistic about the growth potential? And, the retail segment provided almost 2/3 of the portfolio and it's been most affected. So what really is the outlook then?
See, what we did is during these challenging times, which started with the liquidity crisis and then continuing with the COVID impact, we decided to strengthen our balance sheet. So we did a few things strategically. The one is that the corporate lending business, which had structured finance and real estate, we had decided to run off this portfolio. So in the last 18 months, we have brought it down by 50%. And in the next 12 to 18 months, we are sure that it will become zero. So we will become a 100% retail focused company. The second important thing which we did is the raising of capital, which had come from global private equity Brookfield. In the most challenging time, this capital has come, which has strengthened our net worth. Today, we have a capital adequacy of 40% with the leverage as low as 1.5 times. So we should be the most very less leveraged company amongst the listed NBFCs. And Brookfield had multiple options. They chose to partner with IndoStar because of the platform which we have built and the quality of the management team. So they felt that by providing the capital, we can scale up. And the third most important thing we have done is during March 20, we have taken very aggressive write-off and provisioning, including a 280 crores we have taken on account of RBI prescribed provision and macro provision because of the COVID. So I think we have ring-fenced the balance sheet with these three important strategic decisions we have taken. So now we look forward to the growth in the retail businesses of CV, MSME, as well as affordable home finance, where we have built an excellent team. And you are also aware in the immediate term, because of the COVID impact, there could be headwinds. But in the long term, companies which have built a platform, have management team and have sufficient capital will have extraordinary potential to grow. So we are very confident that like in the past 3 years, we have grown our retail book by 4 times. And we can definitely grow similarly in the next 3 to 5 years. So we are very, very confident and optimistic at this point of time.
Sure. Now, almost 90% of your customers have opted for a moratorium. How are collections looking, so far in Q1 21?
The moratorium is viewed as a weakness by the analyst and the media, but actually you have to look at the asset class. So in CV, these are all assets where you have to earn and pay. It's not a consumption like an individual borrowing money. It's borrowed for business purposes. So when the COVID impact came and the lockdown was implemented, so RBI said you can give moratorium. And our retail customers, CV operators who are not plying their vehicles due to lockdown cannot pay because they are not earning. So we have offered in Moratorium 1.0, moratorium to everyone. So about 90% of our customers have opted. The balance people who have not opted paid, and some of them who have opted moratorium also have paid. So gradually from March to May, the number of people who have been coming out of moratorium has increased. And in Moratorium 2.0, when RBI extended it by another 3 months, June, July, and August, we have decided to give a different strategy where we are not going to give moratorium to all the people because 2/3 of our customers have already started plying the vehicles. They have started earning. So we are going to give moratorium to only people who are seeking, and case by case, we will evaluate why we should give. So I am very confident from June, the collections will definitely improve. And we are able to see the trend this month that we see more than 50% of the people will be paying their installments from this month. So that would increase going forward.
Right. Mr. Shridhar, given the weak borrower profiles in the current tough macro environment that one is in, by how much do you expect your NPAs in particular to rise? And also, what are the changes that you yourself are observing for the non-delinquent customers?
See, the environment is very tough and challenging. Particularly, this is affecting some of the customers in the particular industry. For example, if you take commercial vehicles, the heavy commercial vehicles and the fleet owners have been impacted, mainly on account of shortage of drivers, plus shortage of people who can load and unload because of the exodus of migrant laborers from the cities. This is becoming a problem. We have talked to all our customers and we find that 2/3 of our customers have already started playing. And we are mostly in the used vehicle financing, and we have been financing light commercial vehicles, small commercial vehicles, and to some extent heavy commercial vehicles also. So we are not dependent on freight from the industrial production. So the rural market as well as essential goods like agricultural produce, these are all sectors which are coming to normalcy very quickly. So as we are not in those segments, we are not very much impacted. And in the business of MSME, as well as in affordable home finance, we see the same trend. So our quality of already existing book is good, and we have taken very aggressive provisioning and all that. So we don't see much of a problem in terms of NPAs going up. We have estimated that, we have taken the cushion, so I don't think we will have much issues.
Okay, good to hear that. What about the funding scenario? How is it that you're analyzing the landscape here? Because if you look at the margins, they have contracted both on a sequential as well as in an annual basis. How do you see your margin trajectory shape up in the coming few quarters?
So the margins will be comfortable, but in the immediate past, because we have run off our corporate book where we used to get good income, so that we have sacrificed because we have decided to run off that. We used to get a lot of front-ended income also. That's one of the reasons. The second is because of the liquidity scenario, we have been carrying more money. So there is a negative carry there. That's why the margins have suffered a little bit. But going forward, we are going to focus on two businesses in our retail business, which is used commercial vehicles, where our yields are going to be about 18%. Plus affordable home finance, where we are lending at around 14%. In SME, we have 14. In the new vehicles, we will have less. So these two businesses we will do in partnership with banks. Already we have a partnership with ICICI Bank, where we have worked in the last 1 year for new vehicles, and we have generated about 1,000 crores. So the lower yielding assets, we will have a strategy of putting it through off balance sheet. The higher yielding assets, we will keep it in the balance sheet. As we have a 40% capital adequacy, our net interest margins are likely to be between 8 to 9% in the immediate future and 7 to 8% in the long run on a steady basis. So I am not seeing any contraction in net interest margin. Because of the past issues, it has suffered a little bit. We have taken the correction, and now we can look at a very steady 7 to 8% NIMs going forward.
Okay, Mr. Shridhar, good to have you on the show. Thank you so much for taking the time out and joining in to help us understand where business is as of now and where exactly do you see visibility come in the next